Hey guys, what's up people? क्या हाल चाल? So within 1 hour we are starting our module 6 का revision. Okay, we are starting our module 6 का revision within 1 hour. So we are starting our first question. So risk, in how many parts risk is divided? So we have to divide the risk in two parts. First one is systematic risk and second one is unsystematic risk. So this is our first question. What is systematic risk and types of systematic risk? I have already explained you in class what to write in systematic risk. Means what is the definition of systematic risk? Simple. So what is systematic risk? Systematic risk is a risk which will impact on whole economy or on whole market. Okay, I have already given you the notes. Okay, simple. Or second thing, it is uncontrollable in nature. So you have to write 2 lines in this. And third line, beta is a measure of systematic risk. Okay, simple. 3 line which you have to write under the under what is systematic risk. Okay, systematic risk. Okay. Now they are asking types of systematic risk. Sorry. They are asking types of systematic risk. Okay. So we have to write 3 systematic risks. First one is market risk, second one is interest rate risk, and third one is purchasing power risk. First one is market risk, second one is interest rate risk, and third one is purchasing power risk. Okay. Now second question, what is unsystematic risk? So unsystematic risk is a risk which will impact on a specific sector or a specific company only, which is controllable in nature. Simple. 2 line which you have to write in examination. Okay. Or next question, what are the types of systematic risk? So we have business risk, financial risk, and default risk. What? Business risk, financial risk, and default risk. Okay. Now next question. Other risk, they will not ask you the other risk, but for MCQ purpose you have to learn the other risk. Okay. Credit risk, liquidity risk, or operational risk. Okay. So what is the meaning of credit risk? Means the buyer is not paying your money back. Okay, simple. Or debtor is not paying your money. Simple. That is called the credit risk. What is the meaning of liquidity risk? Liquidity risk means you have no cash in hand to pay the current liabilities. Simple. What is operational risk? Operational risk means you have no strategy, your plans are not working, your strategies are not working, your employees are not working. Okay, simple. Now fourth one is market risk. Market risk means market risk is a systematic risk. Okay, market risk is a systematic risk. Okay, operational risk, liquidity risk, and credit risk are the unsystematic risk. Okay, simple. Okay, so market risk, you can just write this. You have to learn this point for market risk. The market risk, it arises due to social, political, or economic event. Okay, now they have divided the market risk into 4 risk, or I can say that examples of a market risk. So equity risk, equity risk means fall of stock market. Simple. Okay. Interest rate risk, change in LIBOR, MIBOR, or repo rate, reverse repo rate. Okay. Now third one is currency risk. Currency risk means reduction in the price of dollar, euro, okay, pound. Or fourth one is commodity risk. Commodity risk means change in a price of copper, crude oil, corn, wheat, soya bean, okay, or other crops. Simple. So these are the examples of the market risk. Now next question, what are the objectives of the risk management? What are the objectives of the risk management? If we have a risk management system, means we have to manage the risk. Okay, simple. If we are easily managing the risk, or we are just making the strategy which will work in risky areas or risky time period. So what are the objective of having that risk management? Okay, so first one, we will anticipate the unnecessary I'm sorry, we will anticipate the uncertainty. Okay, we can anticipate the uncertainty about the future. Second one is channelizing the event to happen the way they are planned. Matlab, if plan A is not working, then we should have a plan B or plan C. Okay, setting right at the earliest opportunity. We have to setting the right thing on the right place. Fourth one is ensure that the objective of the planned event is achieved. Means we have to achieve as per our plan. Okay, simple. Now fifth one is expected event is frustrated, making the damage minimal. We have to think for reducing the damage as much as possible we can do. So these are the objective of the risk management which you have to learn by yourself. Okay, now next question, what are the benefits of enterprise risk management? What are the benefits of enterprise risk management? What are the benefits of enterprise risk management? So first one, by creating a more risk focused culture, integrating risk evaluation into business and IT practices is a good way to improve risk management across the board. Okay, so just you have to keep in mind the risk focused culture. We have to make the risk focused culture. We have to create the risk focused culture. Means the area where there is a more risk, then we have to focus on that area. Okay, simple. Okay, now second one is implement more standardized risk reporting system. Just write system. Means we have to make the standard risk reporting system. Okay, now third one, organization can improve focus and increase their perspective on risk in variety of categories. You have to improve the focus on the risky areas. Okay, fourth one is a greater focus on risk associated with the business or startup objectives. Means you have to focus on the risk associated with the business. Simple. Okay. If you want to leave this question, you can leave. Okay, well, just leave this question, no need to learn this question. Okay, now next question. Now next question. What are the benefits of effective enterprise risk management as per COSO? I have already explained you about COSO. What is COSO? COSO. Okay, so what are the benefits of enterprise risk management as per the COSO? So first one is we have to identify and managing the risk. We have to identify the risk and manage the risk. Then increase the opportunity, increasing the range of opportunity, with the help of this antivirus services, or we can provide cyber security services for the companies which are just making their enterprise risk free, or which are just making the risk management system. So we can sell antiviruses or cyber security or any other kind of security to that corporate or to that company. So there may be an opportunity in this field also. Okay, or third one is increasing the positive outcome. We have to think for positive outcome, don't think about negative things. Okay, fourth one is reducing the performance variability. We can reduce our employees performance variations or variability with the help of AI, or many software or devices are there. Okay, so to reduce the risk, we can reduce the risk of performance variability. Fifth one is improving the resource deployment. We have to allocate the resources. Okay, we have to allocate the resources, or we have to do best utilization of our resources. So improving the resource deployment. And sixth one is enhancing enterprise resilience. Resilience means flexibility. There should be a flexibility of for the company, so they can use, or they can adopt new technologies, new strategies. Simple. Okay, now our next question is, what are the components of internal control? So we have five components of internal control. First one is control environment. Second one is risk assessment. Third one is control activity. And fourth one is information and communication. And last one is monitoring the activity. Last one is monitoring the activity. Okay, our next question, just you have to learn what is financial risk. Financial risk is a possibility of losing the money. Means financial risk, in simple I can say that risk related to money. Okay, so first line, financial risk is a possibility of losing money on an investment. Okay, simple, financial risk is a possibility of losing money. Second one, financial risk is a probability of having negative and unexpected result due to market changes. Simple, if stock market falls, then at that condition there is a negative result. Okay, means we will make loss in a stock market. So funny, or I can call it that is a financial risk of losing the money. Simple. Okay, so you have to just learn two lines. Okay, now types of financial risk. So types of financial risk, we have market risk. Okay, second one is credit risk, and third one is liquidity risk. Okay, first one is market risk, second one is credit risk, and third one is the liquidity risk. So under market risk, we have four types of market risk, or I can say that example of market risk. So you can write interest rate risk means change in interest price, interest rate. Okay. Second one is equity price risk means there is change in a stock price. Third one is foreign exchange risk, and fourth one is commodity price risk. Okay. Now next question, you have to do this illustration. Okay, you have to do illustration number 1. I have already discussed, or I have solved this in our regular batch, so I'm not going to solve this in revision class. Okay, I'm not taking any practical question in our revision series. Okay, now next question, this is very important question from this chapter. What are the features of CAPM, capital asset pricing model? Capital asset pricing model. So formula for CAPM is RF, risk free rate of return, plus beta RM minus F. Okay, so just read first point. CAPM explains relationship between expected return, systematic risk, and valuation of security. Means RF plus beta, RM minus RF. This is a formula which I have already explained you in a class, or you have learned in strategic financial management class. So this shows a relationship between expected return, systematic risk, and valuation of security. Okay. Second one, unsystematic risk of the security is eliminated because they are just taking beta. Beta means systematic risk, so they are considering only the systematic risk. So as per this formula, this formula ignores unsystematic risk of security. Simple. So we can say that unsystematic risk of security is eliminated. Okay. Third one is all the securities do not have a same level of systematic risk. I have already explained you in a class. All the securities shall not have a same level of systematic risk. So there may be a variation in a returns. Okay, simple. So in general, I can say that all the securities do not have a same level of systematic risk. Okay. Now fourth one, systematic risk can be measured as beta. Systematic risk is called as beta, or it can be measured in beta. For measuring the systematic risk, we have to use the beta. Okay, simple. Now next question. What are the assumptions of CAPM model? What are the assumptions of capital asset pricing model? Okay, so for investor we have to learn 3 points. Okay, so investor will think for higher of return for acceptable level of risk. Means if you are taking higher risk, then you will get the higher return. If you are thinking for lower risk, then you will get the lower return. So the desired higher return for any acceptable level of risk and lower risk for any desired level of return. So just you can write higher the investor will get higher the return if they are taking higher risk, or they will get the lower return if they are taking the lower risk. Simple. You can just write simple point. Okay. Second one, their objective is to maximize their wealth. They want to maximize their wealth. Simple. And third one is the choice, or their choice is based on the risk and return of the security. Means if they are taking higher risk, then they will got the higher return. Simple. So they have to choose what to do for getting the return. Simple. Okay. Or now with reference to market, means what market assumption is used in this formula. So first one is information is freely available in the market. Means if we are using this formula, so information is available, like risk free rate of return is 7%. So this formula thinks that, or there is a assumption, or they are taking assumption that this information is available freely in the market. Simple. So information is freely available in the market to the investors. Okay. Now second point, investor can borrow and lend unlimited amount at the risk free rate of return. They are just using we have to use this formula, like risk free rate of return plus RF plus beta RM minus RF. So what they are saying, RF, risk free rate of return is 7%. So they are saying that, or they are assuming that the investor can borrow freely at the rate of 7%. They can borrow n number of amount, they can borrow as much as amount they want to borrow at the rate of 7%. Okay, so this is the assumption for that. Okay, key investors can borrow and lend unlimited amount at the risk free rate of return. Okay. Third one is no tax or transaction costs are considered. Means for calculating the return, they are not considering transaction cost, SST security SST tax, or capital gain tax, short term or long term. Okay, so they are just not considering the any kind of tax for calculating the returns. Simple. Okay, so we have to learn three points in this question. Okay, now next question, what are the financial risk mitigation strategy? Mitigation means we have to reduce the risk. Okay, so what are the strategies through which we can reduce the financial risk? What are the strategies through which we can reduce the financial risk? So first one is plan. We have to do the plan. We have to do plan. We have to do plan. Second one is diversification of investment. Diversification of investment. We can diversify our portfolio. Now third one is exit strategy. Means we have to make a plan when to sell our shares. Okay, now fourth one is purchase insurance. We can purchase insurance or we can do hedging contracts. Okay, now fifth one is create a cash management strategy. We have to create a cash management strategy. Means we have to keep some amount of cash which we will invest in future. Okay, do not put all your cash in stock market at the same time. Okay, now chapter number 4, what are the phases of project? What are the phases of project? What are the phases of project? Means if you are starting any project, so what are the steps for doing the project, or what are the steps for making that project? So first one is initiation. We have to make the outline for this step. Second one, we have to plan. Then after that, after planning, we will execute that planning. Now fourth one, after executing, we will finalizing the product. Means we are just closing the project. Now last one is monitoring and controlling. After completing that product, we have to monitor and control that product. So we have 5 phases of project. First one is initiation. Second one is planning. Third one is executing. Fourth one is closing. And fifth one is monitoring and controlling. Okay, now next question, you have to read this question. It's a homework for you to read this question. Okay, what are the types of risk monitoring? What are the types of risk monitoring? Means how we can monitor our risk. So first one is voluntary. Some risks are voluntary, which are not required by the law. If you want to monitor, then you can monitor that risk. That is called the voluntary. Some are obligatory risk means which are required by the law. Okay, means we have to monitor as per the requirement of government. For example, penalty. You have to just check whether you are paying income tax or GST on time or not. If you are not paying on time, then you have to pay the penalty. Means you have to pay some fine, or you have to check the pollution control devices. So these are the obligations for the factory, okay, or the company. Reassessment. You have to do reassessment. Means you have to check again and again some process or some devices, okay, after a certain time period. Fourth one is continual. Means monitoring is always going on. Means continuity, man. We are just continuously monitoring the things. So there are 4 types of monitoring. First one is voluntary means if you want to monitor, then you can monitor, or if doesn't want to monitor, then don't monitor. Okay, second one is obligatory. Third one is reassessment. Fourth one is continual. Okay, now chapter number 6. What is risk reduction or risk mitigation? Mitigation means reduction, means how to reduce the risk. Simple. Okay, so risk reduction or optimization aims at reduction in the severity of law or the probability that law may not be passed. No need to learn this question. Okay, leave this question. Okay, now what are the characteristics of internal control system? What are the characteristics of internal control system? First one is preventive measure, second one is corrective measure, third one is directive measure, and fourth one is detective monitoring measure. We have 4 characteristics of internal control system. First one is preventive measure, second one is corrective measure, third one is directive measure, and fourth one is detective monitoring measure. Okay, now our next question, requirement of audit for a startup. What are the requirement of audit for the startup? Why we want to do audit for the startup? So first one is for lender or investor. Investor want to invest in your startup, so they want the audited financial statement. So that's why we have to do audit. Second one is pre-IPO. If you want to go for launching your IPO, initial public offer, or you want to trade your shares, or you want to raise fund from the public, so you want audited financial statement for going for IPO. Okay, selling off, if you want to sell off your business, then someone or investor will show interest only if your balance sheet or P&L or financial statements are audited. So selling off. Okay, now compulsory audit, so there may be a limit, for the company for doing the audit, simple, as per the law. So there are 4 points which you have to learn ki bhai what are the requirement of audit for the startup. First one is for lenders or investors, they want your financial statement should be audited. Second one is pre IPO, if you are going for IPO, then SEBI will ask for the audited financial statement. Third one is selling off, if you are selling your business or a part of a business, then interested party will check your financial statement which are audited. Okay, now fourth one is compulsory audited, means as per law you have to do audit for your books of accounts, simple. Okay, what are the benefits of auditing a startup? This is your homework, you have to learn this question. Okay, you can learn this also. What are the reason for a startup audit? Firstly, if investors are asking for audited financial statement, then you have to do audit, or for going for IPO you have to do audit. Okay, now third one is if you are taking a loan from the bank, they will ask for the audited financial statement. Fourth reason is if you want to sell your startup, then also सामने वाला party will ask for the audited financial statement. And lastly, if the board is asking for book record and financial, then startup में तो ठीक है, board of directors, PODs or investors or interested parties are asking for audited financial statement, then you have to go for the audit. Okay, so this question, what are the reasons for startup audit, and this one, requirement for audit startup, are the similar question, simple. Okay, now last chapter, what are the strategies for bouncing back? What are the strategies for bouncing back from the failure? If you failed in your examination, if you failed in your startup, then what are the strategies for bouncing back? Now how you will start again? So first one is failure is not an option, but failure is an option, but it's not an end. Failure is an option, it is not a end, simple. Okay, or refund the loan. If you have taken the loan, then you can just refund your loan. Okay, third one is introspective about things went wrong, means you the business journey should be introspected to figure out the things that were wrong. You have to think about what we are doing wrong. Okay, so introspective about the things went wrong, the things which are going wrong, you have to think again and again, and don't do that mistake again and again. Okay, simple. Now fixing the next move, what's your next move? You have to take the step, or you have to fix your next move. Fifth one is planning, you have to do planning for taking the next move. Okay, sixth one is planning for failure. Planning for worst case situation is a clever move, means you have to plan. If you failed in your startup, then what should be your next step? You have to plan for that also. Okay, if you have planned that if we failed in our startup, then what will be our next move? That is a clever step, that's a clever move for anyone. So there are 6 points through which we can take a bounce back if you failed in your startup. First one is failure is not an option, failure is an option, it is not an end. You should think positive. Don't think that we have failed in my startup, or we have failed in examination, just leave this examination, or take a quit strategy. Don't think about that, just it's an option. Failure is an option, but it is not an era, it is not an end, it's an starting of our era. It's a new start, it's a new beginning for us. Okay. Second one is refund your loan, reduce your liabilities. Okay, third one is introspective about things went wrong. You have to think what is going wrong, what I am doing wrong. Okay, and fourth one is fixing the next move. You have to plan what I am doing, what step should I take, and you have to fix on that step. Fifth one is planning and doing the groundwork. You have to plan for your next move and do some groundwork. Sixth one is planning for the failure. You should know, you should have a plan. If I failed in my startup, then what should be my next move and what should be my next planning. Okay, so you have to plan for the failure also. Okay, so we have revised our module number 6 within 25 minutes. Okay, so you have to just learn the only descriptive portion from this revision videos, or for MCQ portion you have to read this whole concept book. Okay, if you face any problem, then you can just contact me at my WhatsApp number 799993171. Okay, chalo, take care, bye bye, best of luck for our examination.